can. Let's be around an hour.
Sure. We're live.
Okay.
Sorry, I just sort of threw you into the fire there.
No,
what's going on?
Working on my dissertation, and somebody's like, "Hey, all this stuff's happening in the market. Let's talk." So I'm like, "Oh, okay." Like, twist my arm.
Yeah, I mean, what else do you have to do? It's healthy procrastination. You procrastinate.
I guess so. Yeah, my dissertation can wait. It's all stuff from like thousands of years ago. How are you?
I am doing well, man. I'm doing good. Actually, let me go just get a drink, and then I'll be right back.
The guy's like, "Hey, let's go live in the middle of one of your sentences, and then let me get a drink." So, Wally is getting that. Yeah, today we're going to definitely talk hymns, probably mostly hymns, some SoFi, maybe a couple other things too. As always, before put questions that you have in the chat. If it's not something that we're directly talking about, or we just don't happen to notice it at the time, those we'll get to at the end of the stream here. So Tevis, what's going on?
Not much, man. We have some stock stuff. I actually want to talk about some Netflix stuff too. I heard they're like increasing their subscription price as well, but we can get to that. I'll add it to the list because they reported earnings yesterday, right?
Oh yeah, really good earnings.
Yeah,
that's one that Bill Ackman got wrong. I mean, like even the best get it wrong from time to time, but
right, because he sold it at the bottom, right?
Yeah, he sold pretty close to the bottom. He bought Google, which has done well, but I mean, like we can take solace in the fact that none of us are perfect in our trades. Like there's always mistakes you make. Some is just like, well, that's just kind of how it happened, and some you're like, man, it was a wrong process, wrong thought, wrong idea, and also wrong execution. And yeah, so keeps us humble.
So did they increase the subscription price?
I don't know.
Because I saw this. Yeah, so raising the prices of subscriptions. Okay, I want to get your thoughts on this first, just before we go into any other topics. We can start with this one. Since it seems that you haven't gotten the memo, Netflix raises prices on most streaming plans monthly. That's $25 a month. It's like $300 a year, dude.
Yeah, that's no longer cheap. I mean, if somebody watches enough Netflix, but the thing is, a lot of people will watch. They'll have several of these. Like we have Disney Plus, we have Prime Video, we have Netflix, we have Hulu because it was like $1 per month for 12 months or something stupid, and I'm like, sure. And at least for us, like we've not removed Netflix at this point, but there have been times when we're like, hey, I just don't have a lot of time for TV. We've had spent a little bit more just because we had the blizzard of Houston. So we kept our power, and it's like, hey, let's enjoy watching some movies. But no, I don't know. Like I think they're kind of in a different form of price discovery where they're trying to figure out what's the optimal rate here. That'll continue to go up over time, as it has been. Inflation is one of those factors. But they'll lose some people over this, I'm sure. But the question is how many. If it's not many, then it keeps working for them. Maybe they keep raising it. Maybe in like 5 years they'll be at $50, which is
there's no way. Like there is a plateau for this thing, and you're closer to that plateau than you are far away from it. Because at $300 a year, you're automatically pricing out a lot of families, and not only that, but the families that you're not pricing out, you're forcing them to choose between one or two core providers. And you're essentially having this like Hunger Games where Netflix has to essentially be one of those core providers, or else they're going to cut Netflix altogether. And so I think that the more often you raise this and the more aggressively you raise this, you run a higher risk of this having unintended negative consequences on your company. Like, especially with people torrenting stuff illegally and streaming stuff or through VPNs or whatnot. Like if that still exists, like more and more people are just going to use that. I'm not saying I endorse that kind of behavior, but at the same time, like you have to put up Netflix's content library against the price that they're charging, the $300 a year for the premium plan, and ask yourself, well, every single point you go onto Netflix, you have to basically vet whether it's worth it or not. And I think that's an increasingly large question that people will raise the higher the price goes.
Yeah. For us, that's we don't even use a premium. Do we do? I think we have the premium subscription. I'll have to double check that. So no, you're right though. At a certain point, especially that was one of the complaints against cable was it wasn't instant access for everything, but the other thing was you had more and more channels there, but you were paying a very very high price for with a lot of content that people just didn't watch, and so I mean. I think most people will probably just be like, it's fine. It's less than $1 a day, no big deal. But there will be some that end up exiting Netflix. And honestly, I'll have to look. Like for myself, I don't watch. I watch very little, so I wouldn't mind cutting it. But I think my wife watches a good bit more than I do. So if she's watching it several times a week, it's probably worth it. If we're watching it like once a month, give me my $25.
Yeah, I mean, because look, I mean, Netflix is largely seen as a leader in the streaming space, and whatever they decide to do, others will follow suit. And if Netflix decides to be on the vanguard of raising prices and not losing customers, then all of a sudden that's going to send a very clear signal to Disney, Crave, or HBO Max, whatever you call it, and all of these others to be like, oh, well, if Netflix is charging 25, then I can also charge 15 for mine because that seems like a bargain by comparison. And all of a sudden, you have a compounding effect from a customer perspective, and they're going to start cutting services, dude. Like it's going to happen.
Yeah, that's one that I've never really been too interested in. Like I would have done well if I was investing in Netflix, obviously. But over the last few years, I'm like, they're a good company. I don't know. It's never been that attractive to me. Out of Fang, it was the least attractive, the least interested one for me personally. When people kind of moved on from Fang to Mag 7, it's not even in the Magnificent Seven. So it's still something I keep track of. But no, the one thing that I took from that was it's really nice to see, of course, the banks, but also the big players like Netflix do very, very well in a quarter. Tends to be that a bull market keeps rallying on as earnings continue to prove like, hey, things are very good.
Are you doing anything specifically this earnings season around, you want to keep cash on the sidelines, or is there a specific name you're looking to go into, or do you generally think that it's all going to be more positive results than negative ones?
Well, I think it's mostly positive rather than negative. There tend to be at least a couple of names each quarter that I think that they're quality companies that will fall on like the silliest of silly reasons. And so I have a little bit more than 5% cash on the side that's excluding swings and short-term positions. So I have that kind of earmarked for that. The only earnings play that I think that I'm going to make on earnings, other than selling covered calls very carefully on certain names, is cash liquid puts on Palantir. I think that if we get a good dip on Palantir, and we might, I don't mind if they get hit at a certain level, although it keeps running up. So that's kind of annoying because I've not sold the cash secret puts yet. So either my entry for that's going to get less attractive or the premiums. So, but at least that's the plan with some of the money that I took off the table. Just looking to get back in some of those shares if it dips. And if it doesn't, free premium. So not a bad thing. Another one that, my younger brother actually mentioned Fubo, and I have to look into this. So, I don't even know what they report, but they have this deal with Disney, which, as long as that goes through, there's an arbitration amount there. But it seems like that the premiums for the covered calls entering, or the cash secret puts, either way, entering earnings are really high for Fubo. So I don't know. I wouldn't do much money on that personally. Fubo's not something I want to be in long term anyway. But I might swing that just for fun.
Yeah, I know Jeremy was big on that one, and I know it paid off for him because of that Google deal. But that Google deal, and again, this is somebody who's totally ignorant on Fubo's financials and their
Disney
financial.
deal. Disney deal.
Yeah, sorry, the Disney deal. I don't know. It just seems like Disney really saved them, especially from a stock price perspective, because that's the only data point that I've sort of seen, because I don't follow the actual company. But yeah, I don't know. We'll have to see. A big thing as well, like with regards to Netflix, just going back to that conversation, is they're now streaming live events, which is interesting because it encroaches on this space around like ESPN and streaming rights for big sporting events. Like they did the Tyson Paul fight, and they did the Christmas games, the Chiefs, and I forget who the other one was that was playing on Christmas, but I think maybe Lions. There was 2 games.
That's right.
My point is that as Netflix becomes more aggressive in trying to capture that streaming space, then a valuable asset that Disney has right now is at ESPN and the entire sports aspect. With regards to Fubo, like it all connects because Fubo is, very sports related content. It's going to be interesting, man, because Netflix doesn't seem to be stopping anytime soon on the streaming side. And if they're going to be raising prices again, then I would imagine that they're going to double down on that content. I think they said on the call that they have a constant stream of like putting out new releases on a consistent basis. So it's going to be an interesting time. But one thing stands for certain, that Netflix, at the very least, whether it is just normal shows and reality TV or whatnot, or whether it's live streamed sporting events, they have to really prove out that new price point, because, again, it becomes a question in people's minds. And Disney with ESPN and Hulu and Fubo now, like, I just think it becomes a more dynamic landscape.
Yeah, it could be the case. So there's a bunch of credible partners. There's been some consolidation, which is probably healthy for the industry overall. I don't know what that price is. Especially, well, it seems like this kind of subscription is one of those things where people tend to be last on the list as far as if they need to cut things. So even in the face of consumer weakness, I don't know that Netflix gets hit that much. But yeah. They keep adding and building onto that platform, so probably good for them, good for Disney with the Fubo news. But not really something I want to get into as far as investing.
Yeah, that was going to be my other question. Are you looking to get into any of these names? I mean, Netflix is, well, I guess an argument could be made either way, whether it's expensive or not. It's definitely not cheap, if you ask me. But in streaming in general, there's nothing that you're really looking at in terms of exposure to that space.
Yeah, I would rather invest in a company, that has subscription revenue that's growing very rapidly year over year, and is a lot more volatile. Starts with an H.
Oh yeah, we can jump into that. That makes sense. So you can pick up that conversation then.
Yeah, him. So in case somebody's wondering, it's of course they're not they don't have a subscription to their videos or anything like that. Instead, it's a subscription, of course, for the telehealth. There's been a lot of him news, or it seems like that there has been recently. And of course, earnings is something that'll be very interesting to look at. Let me pull up a couple of these things. So to go back 2 weeks, there was a analyst report where they talked about credit card revenue.
You got to zoom a whole bunch.
Yeah. There we go.
Too much. Okay, that's perfect.
All right. So there was a talk from an analyst that was looking at Bloomberg Terminal, and they saw credit card data for HIMS, and they're like, hey, it looks softer than we would expect. This is back in December, and they were basically pulling it from a 5-day spread. Which my issue with that is, like, it's okay to look at that and be like, well, maybe there's some weakness here that we didn't anticipate, but there can be any number of reasons for it just being a little bit weaker over 5 days. Plus, HIMS also has debit cards, and they take credit debit cards too, so it's not their only form of payment. That said, credit card data, and I believe that this person got the data originally from Bloomberg Terminal or a service like that. So this is not my data. So if you think it's wrong, then fine. But they had credit card data on new versus returning customers, and we can see, of course, returning customers. It did go down a little bit and actually bumped back up. This big bump here in January, it shouldn't be unexpected, just because you can see a similar bump usually at the very beginning of the year. But look at the relative size of that versus last year. This is exactly what I thought would happen with HIMS. Weight loss seems to be front and center as far as people's consciousness, not just in January, but even more so as far as searches, as far as traffic, as far as advertising. And especially with GLP-1s, they were even more so entering into public consciousness, to the point where I don't think that everybody that is interested in learning more about GLP-1s are going to go that route, or necessarily should. But what it does is it tends to, that they'll look at this, and if it's right for them or not, they may look at an alternative like HIMS oral solution. Of course, HIMS has a lot more than that as well. But we can see their data looks really solid. Here are the total sales as well for these. This is on a weekly time frame. Yeah, would you say that credit card data looks really weak recently here in January?
I mean, that's a nice looking trend line.
I don't see, like, you can see like individual weeks might be up or down a little bit, but the trend is very much intact, and you can see where it held off here, and they were like, oh no, look, third highest ever week. It's pretty bad. It's a little bit weak, not really that weak at all. So I think they were just inferring a little bit too much. Reddit growth doesn't matter. Website traffic for HIMS and hers is a little bit less. HIMS, is kind of stabilized, but hers is as far as rates have picked up a lot. Row is one of those that maybe we'll talk a little bit about too. Traffic has picked up as well on that. And it's not too shocking, especially around the holidays and shortly after the holidays too. So, but I just thought it was interesting that we got data on this that's a little bit more comprehensive. We actually, even with the analyst note, they noted that website traffic was very good, and they noted that it was just 5 days, but they still, I believe this was with Bank of America, they said, we're going to reduce our price target anyway. And this may be the first quarter where HIMS actually misses on revenue. Now, that's possible, but doesn't seem particularly likely. They tend to hit their objectives. What are you thinking as far as their earnings, revenue, credit card data, and how the new year's going?
Yeah, I mean, look, for HIMS, they came out in Q3 and they grew in the 70% range. This is a business that consistently triple beats, top-notch business, profitable business. For Q4, I mean, they're guiding between 465 to 470 million in revenue. They're guiding between 50 and 55 dollars in adjusted EBITDA. So I do think they're going to be knocking those numbers out of the water. And the reason why is because, number one, analyst estimates are low. HIMS always triple beats their numbers. And like, that's just a trend which we've learned with SoFi. Like, if there's a company that's consistently triple beat over years, then the chances that they continue to triple beat are very high relative to them actually missing numbers, because it shows a culture or a discipline of setting proper expectations with Wall Street. So that's number one. Number two is that this business we're seeing leading indicators. Website traffic is up, credit card activity is up, gross profits are increasing quarter over quarter. They're releasing new product lines quarter over quarter. We had some good news around the tirzepatide as well, which doesn't really affect HIMS at all. But every indicator, or the vast majority of indicators that we're seeing, points to this business being a terrific result. So, I do think that it's primed to not only release 470 million, which is what people are expecting, but to actually release something like, 485, 490, even 500 million plus. If they do that, then, sky's the limit for this name. The other thing, and the last thing I'll say on that, is that similar to SoFi, another business that continuously triple beats, HIMS now has the opportunity to knock it out of the water, not just with their numbers that they release for the fourth quarter and full year 24, but also with their guidance that they release for the full year 25. Because if they come out and they say, hey, guidance for 25 is going to be something, miles above what analysts are expecting, then that has the potential to launch the stock in a big way. I actually, funny enough, today I bought more leaps for HIMS. If you want, I can log in and I can actually find the date for you. But it was a $30 strike price either for 2026 or 2027. And similar story, right? Like I'm gonna buy these leaps on a dip because I mean, even today it made up that gap and it's ended the day pretty close to being green after it was down like 3%. So this is a business that I think people are underestimating. People see this as a super volatile, like Wall Street bets type of stock because it moves in the most bipolar way you can ever imagine. But underneath all of that is a company that flawlessly executes time and again. And that trend is not going to stop anytime soon.
So do you own more leaps or shares?
Shares, like what do you mean leaps or shares?
As far as monetary amount, like do you have more in HIMS for leaps or shares?
Monetary amount. Shares for sure. Yeah. I have a ton more shares than I have.
I was going to lecture you otherwise.
No. I think my leaps as a percentage of my total position might be like 10% ish.
10% of your HIMS position is leaps, about
maybe more, maybe like 15%.
Yeah. You'll probably be mad at me with SoFi. Like SoFi, my leaps. Well, and part of it's because they've run so hard. They're up like 500%, but it's larger than my shares position now by a lot. So when, I think it's more than 500%. But that's the thing with leaps is they can outrun. But for myself, HIMS, I'm just buying shares. I'm not buying leaps at all in HIMS. I think if we get to a certain price, and we're very volatile, so we could see HIMS fall to 20 or even below. That'd surprise me, but at that point, I ended up buying a lot more shares this week with some of those Palantir sales revenue and with some net new funds as well, as you like to put it. So HIMS, if it does well on earnings, it may become my second largest position. Probably won't overtake SoFi, probably third, more likely, but it may be a clear leader even over Robinhood, despite how well it's performing. But no, I with a name that's this volatile, I don't mind not having leaps, just shares is fine. And the best thing about that is, like, even though you're doing the right thing, you're not putting like crazy as far out of the money as you can get, and like 3 months down the road, you're being conservative with it. So I applaud you in that. But yeah, I feel like I have enough volatility with just the shares, and I can hold those forever if I need to. Plus, I can't sell poor man's covered calls on my tax advantage positions. You can only do that with my regular position. So unless it is, regular covered calls.
Yeah, man. I look like HIMS. It's funny because I was over here months ago saying how it's 5% of my total portfolio and I could see it possibly getting to 10, but maybe not. It's now 15% of my total portfolio. The concentration, but also the just the appreciation that we've had in that stock in general has led to it ballooning as a percentage of my portfolio. And a lot of it is the fact that the premiums are amazing because of that volatility inherently, because I'm selling puts on HIMS and I'm selling covered calls. Like I was assigned like 3,000, I think, shares, something like that, over the last 2 weeks, around $26. And I'm just selling 35s for the next 2 weeks for that. And if those get hit, then great. Like I'll bank $10 in a month. But if it doesn't, then I'm happy to own that stock and continue, running the wheel on that position. So the position is sort of artificially inflated because I'm merging my long-term position as well as my wheel portfolio position. But it's just the best of both worlds because it's a great company that's performing, that I don't mind owning the shares, even if it's an in the money price. Like if I write a cash secured put at 30 and capture extra premium and it falls to 28, I'm not panicking. Or if it falls to 25, I'm not panicking. I'll just buy more. And it's a great underlying company that will continuously execute, because generally you will have to make a trade-off if it's like a cash grab. Like this is really risky and I don't really want to own this long term because it's kind of like a shit company. But the flip side is the premiums are great. You don't have to make that trade-off with HIMS. Like it's just a great company and the premiums are great.
Yeah. So it's moved. It's always volatile, but it moved quite a bit on Tuesday. It was up like 8 or 9%, which was good timing because I bought some in the 24-hour market. I'm just like, I'm not waiting. I think that this thing's going to take off. There's a few reasons why it moved. One which I think is stupid, but we've seen it move for stupid reasons in the past. There was tirzepatide news. Did you catch that, Tevis?
Yeah, I caught that. I actually traded that on Tuesday. I can pull up that tweet in just a second, but you can explain the news.
Yeah. So the reason why it's stupid. So tirzepatide is one of several GLP-1 compounds, and it's not the one that Hims uses at all. So the news essentially is like, hey, even though tirzepatide is being removed from the shortage list, compounders can continue to compound. Which Hims they have semaglutide, so it's a different product. Tirzepatide, what the FDA decides with that doesn't really matter. But the stock moves anyway with any GLP-1 headline, even though we know the compounded revenue is only going to last for a certain while. I think the one good piece from that is basically it's established as precedent. So if semaglutide is also removed, it makes sense that they'd still be able to compound that for a little while longer, actually longer than expected. So I don't think it's like completely stupid, but it was kind of stupid. And there are other reasons too. You want to throw up that tweet, Devis, if you found it? There we go. Oh, yeah, this is the other one. So, yeah, I wasn't going to throw this up quite yet, but that's okay. So,
it's the only thing you had up, but you can change your screen. I can throw it up if you want. Oh, you want me to throw? What did you want me to throw up?
You said the tweet on the tirzepatide.
Oh no! I was just going to talk about my trade that I made.
Oh, okay. Well, here, let's throw my tweet back up then, or not mine, but this is the CEO, Anthony. It's Dedham, right?
Yeah.
I'm like second guessing myself, kind of like looking at it. Apple, A for Apple. So if you throw this back up, RFK Jr., when he was announced as the head of HHS, a lot of people were like, oh, this would be really bearish for like pretty much everything. But I didn't think that was the case. And I looked more into it, and it just really felt like he was more bearish against big pharma, against usually, craft foods and that sort of thing, as far as like food diet and certain things, and also the idea that everything can be cured by a pill. So he's said a couple of harsh things on GLP-1s, but it's not that he's opposed to GLP-1s at all. It's just that he thinks that that's not a magic pill for everything. Like, you still need diet, you still need to exercise, a combination of things. And so for a name like Hims, I was like, this is not bearish or bad for Hims, but if the market wants to give us a dip in anyway, then that's fine. And of course, the CEO of Hims tweets out and says, hey, to the, let's see, she's a CTO, correct?
I think so.
I'd have to go back to my tweet. Let's see. COO. So yeah, that didn't seem quite right. So he tweeted out, hey, thanks for representing us. Melissa, likewise retweeted that as well. And, I had, a couple of people, and I think this is a fair observation, just say, well, just because they're tweeting it doesn't mean it was a productive conversation, like I said. But what gives me an inkling that things obviously went well is you have two different tweets about it. If you if Melissa went up to RFK Jr. and he's like, oh, I'm going to shut you guys down. You're not going to be able to compound anymore. I think telehealth is terrible.
Yeah.
She probably would not have posted anything, or the CEO might not have posted anything. So I think it's very likely that is also part of the reason why things ran well, is that the market's realizing, you know what, maybe it is stupid to think that RFK Jr. is bearish on this. Also biotech too. Biotech's done quite well the last couple of days, partly because of that, partly because of his portfolio had biotech in it. So CRISPR specifically.
Yeah, which is interesting because we can talk about that as well, like his portfolio and what we can glean from that. But we saw a similar pump on Hims when they brought in this new, I forget who it was, a new chief medical person, and he was like really favorable towards compounders. So like I've said before, I think that this administration is going to be more favorable. Like it's going to be a better macro environment for him to operate in, especially as weight loss is front and center. So I don't know. We'll see. I'm waiting for management to provide more guidance, more insights on their earnings call, which is going to be in a couple of weeks now. But yeah, I saw that photo. I think DDI retweeted it. Um, I don't know, man. Happy to be a HIMS investor.
And here's one other piece too. So I had 3 HIMS posts in a row. And I'm like, yeah, we need to talk about HIMS.
All
Yeah,
right.
buying Celsius is saying that we're pumping HIMS. Is like,
Yeah, dude, buying Celsius. Hold on. Let me just give this a shout out to this guy. This guy just comes on the stream, and whenever he's on the stream, he just buys me a can of Celsius. And I appreciate it, and I love it. I mean, if we can't get a PR from Celsius to sponsor this stream, it's the second best thing. So thank you. But yeah, continue.
well, anyway, you've probably seen the Alpha Sense before, where they have interviews that are very, very long. You can pay for the whole thing, or at least an excerpt. We won't go through all of it, or really even much of it. But the expert in the field seemed to be very focused on Row, which is a direct competitor with HIMS. They do some things very differently as well. And I thought it was really interesting because they had them talk about in one of the last slides, and I won't even pull it up. It's a little bit too fine. Is that the weakness in Row's model is that it is not profitable, and they would really have to ditch a lot of their marketing expense to be profitable anytime soon. And they're probably not going to do that because that'll cause them to stop growing. So yeah, Row is not a public company, but they're a direct competitor with HIMS. And there's a lot of other companies that are kind of like HIMS as well. That's one of the bear arguments on HIMS is like, oh man, there's all these companies out there that are, basically exactly the same. What gives HIMS the edge? And that I think really highlighted it well is that most of these other companies are not profitable.
Right.
And they can't be without really cutting either R&D completely or marketing or both. And HIMS is not doing that. So let me, actually, I'll do this. Visualstocks.com, not a sponsor, but let me share this here. All right, so with HIMS, obviously, if we look at net income, they're profitable. This makes things look a little bit better than they really are for that one-time spike. But you can say they've been profitable for a full year, and this quarter won't change that at all. Their cash flow, they have fantastic free cash flow, operating cash flow as well, and operating expense. They are not cutting corners as it relates to R&D, G&A, or S&M. So they're being very consistent on that. If we look at key charts here, there was one other one that I thought was really interesting, and this is operating leverage. And so if you look at operating leverage, their revenue continues to climb. Their operating expenses climb also with that. Part of that is a function of that marketing that they have to do. But you can see that there's an increasing gap over time. So when HIMS was back here, I saw many people say, and I see where they're getting this from because I think this is the case for Roman and for others as well, is that, maybe they end up being profitable, maybe not. But the thing is, they're just going to continue to have to ramp marketing alongside with their revenue, and there will be no real separation here. It's going to impact their margins. And that's not been the case with HIMS. They're making money. They have very, very high margins. Part of that is they control their costs on the front end. And they will, of course, have a very sticky moat with the personalization. So that subscriber revenue is really, really a good thing with the personalization. So
I mean, look, I can try to play devil's advocate and say, logically speaking, if I was not the number one in this space, or if I was somebody like Roe, who's not even public, and by that I mean not beholden to the whims of the public market shareholders, I would say, hey, the only reason I'm not profitable is because I reinvest every single penny I make back into sales and marketing so as to catch up faster and win market share as a result of that. Right? Because that's the main expense.
Yeah. And I see Nick asking if Row is vertically integrated or they're using third-party manufacturing. They do. So they do a couple of different things. They do. They don't have, as far as I can tell, the level of personalization, and maybe not any personalization. I thought I saw one or two things, but I didn't care enough to be on their website like long term. What they have gone after, and I think it was a mistake. Amazon also is going after this, but I don't think it would be a mistake for them. Is insurance revenue. So a lot of the insured products, like they go after that, and insurance reimbursement is just a nightmare, from what I understand. It's one of the reasons why other companies in this business have fallen, and it's one of the reasons why Hims is not really going after that, is because it's much lower margin, much lower profitability. So Row is not nearly as vertically integrated as Hims is. Hims almost trades like a SaaS. It has margins like a SaaS, and really, Anthony Dudham, had said that it's really a data play that they have.
Andrew.
Like they're able to. Andrew, thank you.
We're like morphing Anthony Noto and Andrew Dudham.
Yeah, exactly. The best CEOs are they start with an A, and it's just Alexander.
Right.
Yeah, I have a disproportionate amount of CEOs that I've invested behind whose first initial is A. So that's
the realization.
Yeah, 4 of them. So that dominate my largest. Well, 4 of the top 5 positions I have are all with that. Vlad just needs to change his name to like Alexander or Anthony or something.
Yeah, Elon,
yeah. But no, I just thought that was interesting. Just have a lot of the Hims news come out all at once. Earnings are a little ways away, so maybe we'll do an earnings preview, you or I separately or together on that. But I think that'll be a very well positioned. I hope that they give us just a little preview of like how January is shaping up so far when they do share. But and Roy Nilo Alvarez mentioned, that there's insider selling. This is a company that has
Roy Nello.
Okay, I see it.
Alvarez. Anyways,
not the. I see the face now. So, any company that does a lot of stock-based compensation, and Hims does, you're going to see insider sells a lot. You'll rarely see insider buys, just because you're given all the stock that you need or could want, and a lot of your net worth is tied up into that. So I wouldn't read too much in insider sells when there's heavy stock-based compensation. Like they say, there's many reasons to sell. There's one reason to buy. So if you see buys, get excited, but sells and it's heavy SBC, it's just kind of a feature. If you don't like that, don't invest in that kind of company, but it's going to happen a lot.
Every CEO of your favorite companies sells stock on a yearly basis. It's called a 10. What is it called? 1001-5B plan. Something. It's a pre-sale, a pre-scheduled earnings selling plan. So they're not like selling. It's all pre-planned. Is what I'm trying to say.
Yeah. In essence, it's kind of like if your pay package, instead of getting paid salary, that like half of it was, or maybe even more than half, was stock. And so maybe once a quarter, maybe once a month, maybe once a year, you just pre-plan like, I would like some money so I can take my family on vacation or buy a third house or something like that. Or if you're Tevis, just, buy the entire country of Japan.
Dude, I
or
would.
Greenland, was it? Which one are you buying?
I'll take either, honestly. They're both islands. Okay. What else do we have to talk about? The only issue with Hims is the mega volatility. Hope that calms down. Yeah, I think you're mistaking that because that volatility is also your opportunity to buy the stock super duper cheap, man. If you had a stock that, like, the reason I really like SoFi, just to make a parallel to Hims, is, and somebody asked me this yesterday. They were like, "Hey, like, why did you pick why is SoFi the stock that you chose to cover and make your largest position?" And it's honestly, in many ways, the same reason as Hims, is because I can see something that the wider market seemingly hasn't realized yet. Like, I can buy Meta, or I can buy Nvidia, or I can buy whatever, Amazon, and like I can still make money because there's still some alpha to be had because I'm on X all day and looking at the news and whatnot. My point is that you won't make as much money because in the case of SoFi, for example, they were executing for years and the stock price was $4, $5, $6 a share. And in the case of HIMS, yeah, sure, like we jumped into it fairly late, comparatively speaking, but we still jumped into it like $13 a share, $14 a share. And still, it seems relative to what they're putting up, the market still discounts them because you're seeing BS articles bring it down. You're seeing like terzepatide that Eli Lilly is like random cases bring it down. And so people are missing the forest for the trees. They're focusing on super micro stuff and they're selling off HIMS as a result of these micro stuff. And so that is a prime opportunity to accumulate more shares because for as long as that variance exists between the fair value and between what you're buying it at today, and you know that to be the case, you have that conviction that, hey, this is not fair for it to be this low, then it's only a matter of time.
Yeah, it's I think, fairly rare to have a name like that the market, that trades as volatile as volatile as HIMS does. It's just a ridiculous amount of volatility, which is an opportunity if you're into selling options or if you're just looking for taking a little off the table if it runs up real high or a little bit buying a little bit more when it goes down. Like you can trade back and forth, even on a position where you have like a core amount of shares that you're just like, I'm keeping this. And then you have some that you add on if it gets low and some that you sell when it's high. I've done that before. That's not a bad way to do that. For myself, it's just about the premiums right now. Lisa even mentioned that she wrote some options, bull put spread. Nick outlined a strategy also, as far as what he's using. And I don't know. I'm pretty happy with my HIMS position because I added, I think, 40% more to my HIMS position this week. So for me, that's a good amount. It's basically up there, unless HIMS falls in price, close to the maximum that I allow myself to put in any position that isn't named Palantir. So yeah, it's a nice place to be, and it's nice that if downside happens, like half the time for HIMS, it's something that is just completely unrelated. It just Amazon it exists. It's like, oh, okay, cool. Cheap entry, that's awesome. Or, oh man, terzepatide, like, if it comes out that it's shortage list or whatever, bad news, it's like has like literally nothing to do with HIMS, and it falls 20% based on that. That's awesome. That's a really good opportunity, especially if anyone watching identifies that and is like, okay, this has nothing to do with the company, so probably it'll recover, in a week or two when the market realizes it was being silly, and yeah, that happens.
Yeah, I mean, I'm playing spreads on HIMS as well. Like I said, I just sell cash secured puts, out a couple dollars from where it's trading, and I sell covered calls. And I'm way more conservative with my covered calls than I am with my cash secured puts. Like sometimes I do cash secured puts at the money or even like a dollar higher than what it's trading at.
And you'll want to reverse that when we eventually go into a bear market, and it may not be for many years yet. But in a bull market, I think it's right to be very aggressive with your cash secure puts and very cautious with covered calls, unless you don't mind getting rid of the shares.
Yeah, I mean, like by the time we go into a bear market, my cost basis on HIMS will be negative.
Yeah.
At the rate that it's going, honestly, like I'm not even joking.
Yeah, I posted a video the other day on like my moves and what I bought as far as like sizing. HIMS was the number one move that I made, but GameStop was up there, and I had somebody comment on there. They're like, "Yeah, my cost basis on my GameStop shares is like negative $18." I'm like, I know how that happens. And that can happen. Like, that's a beautiful thing. There is a risk about selling options, but man, once you understand it, make sure you study it first. Maybe paper trade it for a while too before you're comfortable. But there's a real opportunity to lower your cost basis to basically nothing, and make money while stocks are relatively flat, or make money on stocks that are very volatile and somewhat flat, like HIMS.
I saw TJ recently entered HIMS. Like he was starting to wheel HIMS, which is like amazing because, I've been talking to him a little bit about that one too. So I got to catch up with him as well. It's crazy, man. Like I remember, Chris, Data Driven Investing, was one of the first ones to talk about HIMS, and then we started investing in HIMS and starting talking about it more. And now it seems like so many other people are into HIMS. Just fun to see, I guess. I don't know. It's just the content creator effect of these stocks is so viral. Like one person starts talking about a new stock, and then all the content creators are like reacting to that person, with their new stock, and then some are convinced and some aren't convinced, and it's crazy.
Yeah, I saw DDI. Tom Nash was another one that was talking about HIMS like at $5 or $6 or something. And at least at that point, I just wasn't interested. But there's so many companies out there, and you can kind of forget and lose track of one. And then when somebody posts something or does a video that gets your attention on it, you're like, maybe I should rethink about that. Maybe I should take another look. And that's what happened with HIMS. Of course, you were basically the one that's shoving me to do that, and I'm glad you did. But there's so many companies out there. I'm not going to like take every single company, especially because I'm just doing this, more as a hobby than anything, and analyze every single company out there. But instead, interesting names that are getting a lot of attention. If someone's like, "Hey, take a look at this," usually I will, and be like, it might be okay, it might not. A lot of times I'll have no strong opinion on it. I don't trade those. I don't enter those.
Yeah, like I was just going to add that Tom now just recently made a video on SoFi, and like if you think about SoFi, it was, us on the SoFi Weekly side, and then like I remember myself and Data Driven Investing, we had it since IPOE, basically, right? And then eventually Jeremy got into SoFi, and then now like Tom is talking about SoFi, and like I agree with this comment from Sanjay saying, hey, if we had a content creator ETF, that would be amazing. That'd be something cool to do, man. Like I was talking to Matt earlier today. We were just on the phone, and just mentioning him, we'll probably summon him in the chat. we were on the phone, and we were talking about like what is a way that we can leverage the combined knowledge base of all of these content creators, because everybody has a specific niche, and it would be so cool to essentially have something all together where everyone can talk about their own stocks, but on a combined platform. Like you have CNBC, but then CNBC, you have all of these different segments of people talking about different stuff. I don't know. There's a lot of free and valuable content on YouTube, and that's been proven largely to be profitable, right? Like you guys nailed it with Palantir. Matt has nailed it with Rocket Lab. Like, and I think SoFi, which was like the last one to move, finally did move. And so all of our picks to some degree have done well over the last several years. And it would be so cool to just join forces in some way. I don't know. I'm just spitballing right now.
And I do, as far as those names and that idea of an index, like I don't know like how if you, some of the names are really quality that's out there, but there's some that I don't believe in at all. Like NEO is one of those that offer on, like get a lot of creators' attention. And I want nothing to do with Chinese stocks at this point. And NEO in particular, I don't see it. AMD is one that's getting some attention, and it might be worthwhile doing that. Grab is one that I looked at. I'm like, I don't want to grab a bag of that. I'll pass. And I think, it seems like it'll be okay, but there's, on the other hand, like a lot of these, like Nubank is one that I don't know that I would have considered as an investing case, except for Tanner just banging the table long enough that I'm like, okay, it is. And I acknowledge it. I was like, awesome company. They're growing well. They already have exposure to a semi-bank, SoFi. And that's international too. There's risk. I don't know if it's worth it. And it took me a while to really get on board. But like Hims was that with you. Yeah, you got my attention with Hims. Palantir, probably. I had heard of it before, but like there's a lot of people putting out content on it. Really helped me understand that well. So it's kind of nice just to have people to introduce you to like, here's what the thesis is on this stock, and then you can look at it by your own. Look at the fundamentals, look at how it's growing, look at the filings, see if the thesis is really there, if it's strong enough and compelling enough for you to get in. Most of the time, I say no because I like super concentrated portfolio. And being very selective, and I'll get it wrong occasionally, but my barometer for how strongly I have to see the thesis is pretty high, so that helps me avoid a lot of traps.
Yeah, I mean, like, and that's interesting that you mentioned that. Like, there's a lot of foreign companies now that I'm seeing people talk about, and to me, I just attribute that mostly to we're in that part of the cycle where there's like the opportunities are not screaming in your face anymore, like what was going to run has run. And, that's where I find like the grabs. And like, I remember back in 2021, 2020, where Tesla ran like 10x, and then people immediately were like, this is the next Tesla. And there were like all of these EV companies that none of them really exist anymore. Like the Workhorse and the Lordstown Motors and, all of these random ones that all just sort of went bankrupt. But they were being propped up in that market because every single person saw what Tesla did. And they were like, this is the next Tesla. And it just feels like, we're approaching that part of the cycle again, where people are now stretching outside of their margin of safety to try to find outsized returns. And they're probably better off just doubling down on their winners. It's difficult to find stocks like that. Like it's difficult for us to find, like if I said, hey, Roy, go out and find 10 Palantirs, you couldn't do it. If you said, hey, Tev, go out and find 10 SoFis, I couldn't do it. You know what I'm saying? Like it's difficult.
Yeah, I think Nubank is SoFi-like. So maybe you could find 2, maybe 3. Hims, you might find 1 or 2. Palantir, I think there's only 1, but maybe you'll find another. You're like, oh yeah, C3AI. Don't do that, but maybe. But their quality companies are rare, and there's companies that can fake it for a little while. Not saying that they're doing anything illicit, but they can do like the row approach that we talked about, where you're just spending massive amounts of money for revenue acceleration. But at some point, you have to see that separation, like Hims has. Yeah, not every company can be a Joby.
Dude,
just messing with you.
What is Joby doing? Because I knew it was up, and Tanner was giving me shit about it because I haven't bought it yet. I'm not gonna.
So, yeah, he's. Oh, actually, let me do it this way.
Joby is currently trading for $8.77.
Yeah, what's the year to date?
Oh.
I think after this, let's get into some questions. I see a lot of good ones.
Sure. Joby year to date is 8.4%
up. Yeah.
8.
Let's see. So I think you're maybe losing, or maybe Chris is. Lemonade is down 15.66%. And I'm not wanting to share my screen.
It's down 13%, bro. Don't scare me like that.
Lemonade?
Yeah. Or is it down in after hours?
Oh, okay. Yeah, 13. Huh. I wonder why that said more. Hims, which we've been talking about. And of course, I feel like I'm going to win and just walk away with this. But like, to be fair to you and Chris, like if you had the opportunity to give Hims to somebody that didn't hold it, you would have done the same thing. So
this is like, honestly, Roy, like I want you to win, but I feel like it was super luck of the draw, because if you go back to that stream, Tanner was like, all right, let's get started. And first of all, I'm giving Tevis a gift, and and it's just like, dude, like I didn't have the opportunity to even give, because like that was going to be my stock, and then I had to scramble to give Lemonade because now I'm concentrated. But he wanted to just give me a stock because of Unity.
Yeah, that would have been so funny. Double down or something. But yeah, Hims is up 18% year to date, and I would have. like if I had you, Tevis, I probably would have given you Robin, even though it was way up. I'd actually be up more right now because it's been killing it. Although I didn't expect it to run like this. Joby, did you do Joby?
I think I've learned the hard way to listen to my friends when they tell me something, because I didn't listen to Matt when he told me to buy Rocket Lab at like $5, and I didn't listen to Roy when he told me to buy Robinhood at $14, and I didn't listen to Amit when he told me not to sell Palantir in the teens. So I am the root of all of my problems, and I need to listen to my friends more. I think that's my conclusion.
XYZ. I hate that Square changed their ticker. I just hate everything about Block, Square, XYZ, whatever it is. Block is basically flat on the year. It's up like a little bit less than 1%. So, but yeah, no, like that's the thing is when you have somebody that you respect and they feel very, very strongly on a position, it's worth at least taking a look. You might look at it and be like, hey, I just don't see it. I don't think this is going anywhere, and that's fine. Transmedics is one of those. I saw a lot of people look into that, and it's not that I disagree with them. It's just like organ transplanting. I was like, I don't know that business at all, and it's not straightforward. So, and they have some logistics stuff there that's just it's weird, and I'm like, nah, anything like that. I'll just say, okay, I'm not getting into this. Hope it works out for you. So one of the questions that I saw, and maybe we can start at the top, but I did see this a couple of places, was Enphase, and a specific mention about, I don't remember the exact question, but the market possibly getting it wrong. It's from Ali. A lot of data centers are coming to the United States. I believe energy consumption will increase. Do you think the market is misreading importance of Enphase? 4:10 p.m.
5:10 p.m.
Yeah, Eastern time. You're right. It is so low right now, and so Enphase is getting smacked around. Part of that is, of course, Trump's comments on removing a lot of the Inflation Reduction Act, which is the silliest name ever. But there are some green energy proposals on that. But energy credits itself, manufacturing credits rather, have not been removed. There's not been an executive order to do that. I think it's highly unlikely that Trump does that. There's a lot of state and local incentives as well that remain. I don't think Enphase is really hurt by what's happened. And in fact, a lot of his executive orders were about furthering energy. Trump is very focused on oil, certainly nuclear to a lesser extent, coal as well, and not as much of the green energies. But this isn't a either or. Like you have to pick fossil fuels or you pick green energy. We just need a ton of energy. And there was a article back in December that I posted about where they talk about the sheer number of data centers coming. Like there's more being built than exist right now. Like in Phoenix, they're having massive energy problems just because their grid is not able to keep up with all the growth. They have a ton of data centers there. So we need energy. Solar is one of those that's a lot easier for them to implement on a smaller local level, but it's all of the above. And so I think solar is going to do a lot better than people expect. In Enphase, like that's the thing is, if I was buying some like sketchy panel company that's only been around 3 years, I would be really concerned. But Enphase is a leader in the space. I think they're one of two really, especially on the inverter side. And you can look at Tesla too. They have overlap as well, but they still make money despite being in a heavily cyclical market that's really struggling right now. So, it's mostly about rates. Rates will fall some, despite talks of no cuts this year. But it's really for Enphase, even more than rates. It comes down to people buying and selling homes. That oftentimes when somebody gets their new home, they have some money that they've reserved as equity that they'll install solar systems for, or they'll be moving from a house that they had solar and they really believe in solar. They want to have that at their new place. So right now, mortgages and that market is not very good. That's also hurting them.
I'm just glad that you didn't gift anyone Enphase because it's down 15% year to date.
Yeah, and I bought more Enphase too. But no, that's one of the things is it's very clear to me that Enphase is being depreciated by the market, but I have no clear sense of when that will change. Right. So I've not bought any leaps. They're all shares, and it's not a large position for me at all. Just because I'm happy to wait, I'm happy to accumulate, And I know at some point over the next few years, things will reverse, and you can see where Enphase has been. That's what it does when it's in a bull cycle. Is it does very, very well. They print money. They still make money right now, so they're not going anywhere. This will be the third bear market cycle for solar that they've survived. Might even be fourth.
What would cause you to buy more Enphase?
To buy Enphase?
Like to increase it as a percentage of your total holdings and to actually take a more serious position in it. Because like I own Celsius, but I don't really like ask me what the price of Celsius is today. I couldn't tell you because I don't like ask me what the latest news is on Celsius. I couldn't tell you because it's like what 0.4% of my portfolio. Like who cares?
Yeah, there's a few questions on Celsius too, so maybe we talk about that next.
Sure. But my point is like
yeah,
Enphase to it sounds like Enphase to you is what Celsius is to me. And my question is, what would be the catalyst to make Enphase more like a HIMS type allocation in your portfolio? Like, is there one? Is there a specific piece of news or legislation or something that comes out?
It's all more macro than Enphase. Enphase, I think, extremely quality products. I think their new inverters, the IQ8, are very, very good. They've gotten a lot of traction. Even some deals were noted because what they're able to offer. But it's mostly about rates and home sales. So if we see, we might, I think, see the inklings of this, and it's weird because the 10-year Treasury bill is where mortgage rates are basically pegged to. So if the 10-year is up and high, and it certainly is, let's actually take a look at that. 10-year. Okay. Up a little bit today. This is over the last year, so you can see there was go away. All right. Okay, forget that. I'm not taking out my ad block for CNBC. It's been a little bit higher, but it's 4.6%, which means mortgage rates in this area are like 7 and some change for even like 800 credit score folks. Usually, and we've certainly seen this is the case, at least here recently, it's really slowed down the housing market. Home starts are doing okay, but as far as mortgages, they're way down. But even though the data, which is lagging, says one thing, like on the other side, there's a lot of people that are saying this. And I've talked to some real estate agents, and I've talked to somebody that's in certain segments that are kind of related to this as well, in a couple of different markets that are all saying, no, the real estate market's actually doing well and it's heating up. Now, real estate is always a local market. And so things in Houston, for instance, because our economy is very much tied to energy, can be very different than the situation up in Minnesota or something like that. So, take that with a grain of salt. But I think that despite the rates, that we are going to see a little bit of acceleration in the next couple of quarters, probably this spring, and usually get a bump in spring anyway on house sales. But if that accelerates more than I expect and more than the market is appreciating, and there's not a natural idea, I think, in most people's minds that are trading Enphase, like housing is doing really well, then Enphase should do well. But it's true. It's absolutely true. If you chart that out, I need to do that at some point too. So if I see that continued disconnect between stronger macro, stronger housing sales, and Enphase's price lagging, that's one indicator. Another, which the market does understand this for Enphase, is rate cuts. Rate cuts are very, very bullish for any major purchase, especially on the consumer side, which is Enphase. So if we see unexpected but more rate cuts than we're looking at, like the 2 or 3 this year, if we get like 5 or 6 or 7, unless the sky is falling, like that's fantastic for Enphase. And then the last piece is, of course, just price and price action. If Enphase comes out and let's say just for this quarter that they end up actually having negative EPS, that can happen. They had some layoffs and things that I think that'll make that a one-time event almost for sure, especially with the new inverters coming out and that ramp. But let's say that they do and they get sold off to like $35 or $40 a share. I will buy more. that's the point where if I get into the 40s, that I'll start buying some leaps. They're going to be as long dated and not that far out of the money. I'll be very conservative with them, but it just makes sense at that point. Like it's kind of like with PayPal when it was trading like $50 a share. Is like it's basically completely de-risked itself and still making money, and they're still buying back their shares. Also true with Enphase and a leader in their space.
Dude, if Enphase hits 40, I promise you, I will follow you into that leaps position.
All right. Sounds good.
And speaking of the leaps position, I just actually made a tweet as you were talking around Celsius saying that, hey, it's at $25 right now. Is this a good time for me to start on my leaps position, which I've been talking about for the last couple of months? Very quickly on that for people who haven't seen that stream, basically saying that Celsius right now, like Celsius is somewhat cyclical, well, very cyclical, because of the order values with the Pepsi deal. And right now, I think it's very oversold and will come back. And I don't want to necessarily lock up a lot of capital investing in Celsius. So I'd rather do a smaller percentage of capital, but in the form of leaps, like 2027, $35 calls or something, and go through it that way. But I was saying back in November and December that I think that there will be a lot of tax loss harvesting, and that December, January is kind of a no-go zone. And at that point, I'll enter the position. And now it's down to $25, which, I mean, I think there's more reward than risk here, especially with a small amount of money that's levered, similar to how leaps are. But I don't know. What do you guys think?
Yeah, I mean, I'm the only one here, so.
No, I mean, people can comment in the chat.
I know, I'm messing with you. Yeah, you and I have talked about Celsius before, and I looked at Celsius about the same time as HIMS and just went into it as a swing, got out of it. When I go into a trade for a swing, if it doesn't work out, like the worst thing for me to do is say, well, I'll just go long now because I'm stuck. Like, no, I'll cut my losses and move on. Celsius, I think, is a commodity. I think that they're going to be impacted by lowering margins because of the competition in that space as well. European growth is attractive. Pepsi at some point will run through that massive order that they had in Celsius products. But it might be a little while. Like we have no clear picture of when that will be. So I think it'll be an okay play. I'd almost rather just invest in Monster Energy drink if I was going to do that. But likewise, that's a commodity, has some of the same kind of pressures. So I'm just going to sit that one out, even though I think as a trade, it has that's why I went into the swing position. I think it's compelling, especially right now. But long term, I don't want to be in that thing. And so not swinging it. The only weird name I'm swinging right now is GameStop. And I am.
Okay.
I would rather be in GameStop than Celsius.
GameStop is one of those where, like, if I want to put my DGen hat on, I would put on a leap on GameStop just on the off chance that Roaring Kitty makes a tweet and pumps a thing like 20% in a single tweet, and then you can just roll out of that leap. Because like he did it last week or 2 weeks ago, and it went from like $23 to like $33 immediately. And you're just like, dude, if this one guy has so much power over this thing, and I can put a $25 leap or a $30 leap on it, I don't know. But that's a gamble, right?
Mm-hmm. I see a question on Nubank. $17 leaps for January 2027 is what I'm looking at.
Yeah, this one is mine.
Yeah.
Shall we wrap there, or is there any other questions?
Man, there was something else that I wanted to share.
Oh, we didn't talk about SoFi.
Let's do that. But before we do the GameStop thing, like I know it's associated with degeneracy, and I kind of laid out this, in a separate video. And I think talking with you guys previously, possibly, did I do that with you?
I don't think.
Okay, so real quick, the Trump coin, the meme coin, and the way that the market is behaving right now, it's very, very, very clearly risk on. We just had a short period of risk off, which usually means risk on in a bull market is going to last for a little while. GameStop is one of those positions that actually has a high amount of alpha, relative to the market. It doesn't follow the market very closely at all. Is that alpha or beta? I might have that reversed. But being in a risk-on environment, GameStop is not an exciting growth play. It's not one that I want long-term. It's one that I'm swinging back and forth. But basically, the premiums are really are there, and the way I'm swinging it is just by selling covered calls and cash-secured puts. And it has a lot of cash. It makes money. They tend to actually beat EPS. Their yield, part of the reason why they're making money is because of the treasury yields. That is going to be going down over time, but they have a larger and larger position of cash and basically no appreciable debt because they've been doing their funny things with their stock. So I don't think it's a compelling play, but it's basically like buying treasury bonds that have virality and an upside, from Roaring Kitty and stuff. So and I get premium, by selling cash secured covered calls and cash secured puts. So it's a little bit degenerate, but it's not nearly as degenerate as you think. But it's certainly not a long-term position for me. I don't want nothing in that. I'm not like pumping it GameStop to 10 billion or whatever it is. Like if GameStop goes up, 15%, like, all right, good enough. I'm out.
I'm sorry, did you actually compare GameStop to treasury bonds? I'm going to clip that segment out of context and I'm going to put it up on Twitter and be like, this is my quant.
It's kind of that, and it's kind of like Ryan Cohen also has approval from the board of directors to trade, in the market. So it's like owning a little ETF too. So I don't know. It's not an amazing play. It's not super exciting. It's kind of like, well, I've got cash that I don't really want to deploy in the market. GameStop is a lot safer than people expect. Has volatility, has high premiums, I wouldn't say high upside, but has upside potential, especially in the current environment. So, no, I think that swing's going to work out pretty good. But I thought that was Celsius too, and I got burned. So we'll see.
Got it. Anything else?
SoFi.
Pokemon. Oh, yeah. SoFi. I should honestly probably do this. Just the $100 that I have for Joby, just buy like a leap for Joby or buy a call for Joby and just YOLO it. It's going to go to zero anyways, even if I buy the shares. Okay, SoFi. So an analyst came out, one of our favorite analysts actually came out and reiterated his $6 price target on SoFi. And you could argue he killed the momentum on the stock, but at the same time, it wasn't like today was a super green day to begin with. And SoFi, I think, held up fairly well. Like it made up a lot of those losses intraday and closed, pretty much close to where it started. It fell under 2%. It was down like as much as 4%, I think, at some point. Kind of BS that these analysts can still release $6 price targets when the stock is trading for $17 and have no negative implications. But, that's life, I guess.
Yeah. And the crazy thing it's all the same argument basically around fair value accounting. So they say, oh, SoFi's not doing it right. Here's how you do it. And then they want to value SoFi on its tangible book value, which I understand banks traditionally do trade on that, and that's fine. But when you have a bank that's growing as rapidly as SoFi is, and you might be, oh, what do you mean? It's not growing 100% year over year or 50%. No, but for a bank, like it's growing really, really well. New bank is growing faster, and then you have SoFi right after that. So it should at least get some sort of premium over names that just are not growing that fast. JP Morgan Chase, Wells Fargo, Bank of America. Those are slow growers, and they have fabulous quarters. But SoFi, it just doesn't compare. So I think that the market, not really. It is kind of amazing how much the price action can be influenced in a day or two when there's an analyst that comes out. And I think it's part of its algo trading. There's some people that are newer in SoFi that just like, hey, maybe now's a good time to take profits, or they get scared because they're like, wow, that's so much lower than the actual price. But usually the market fades these moves, whether it's to the upside or downside, fairly quickly. And I think that's what we're seeing. There's a lot of momentum for SoFi. And let's see, you sold some covered calls on SoFi, didn't you?
Hey man, those covered call, like that covered call position is up like 40% today.
Yeah,
Like,
no, I thought that was pretty genius. It's for the 31st.
yeah,
For
$23. You know, like people love to talk smack, but at the same time, like, I thought about closing out that position and just capturing the 50% gain, almost 50% gain in one day. Probably should have, but we'll see how it goes tomorrow. Like it could be green tomorrow. It could also be red again tomorrow or flat. And I could still close out that $23 position even before we see earnings, right? Like that's the thing that I like about selling options is like I can choose to close it at whatever point I want.
Yeah, you're not locked in. That I did sell some options for this week for $20. So I'm thankful that we got a little bit of a pullback today. If it were like 19 and some change, I'd be like, oh man, I'm gonna have to roll. So I think it'll be fine. And I actually really like that play. So I might be selling at that same level, although for a lot less premium.
I got 1%. Hold on, let me actually pull this up. I'm sharing my screen. What did I get on it? SoFi, I opened it on January 21st, blah, blah, blah. Yeah, I got 20 cents. 20 cents for $23. So almost 1%.
And that is into earnings. So that's one of the reasons why IV and the premiums are up a lot higher. But I mean, if you don't mind losing some shares at that price or rolling, it's not a bad thing.
Yeah, like it's and the reason why you're like, oh well, 1% is not that much money, blah blah blah. It's like, dude, it's a $23 price target by the end of January. Like if it hits $23 and I have to, God forbid, give up my shares that I got assigned at $14.50, like wow, that's a horrible situation to be in. Like I was writing cash secured puts, I got assigned on these shares at $15, $14.50, and now I'm giving them up at 23 in 2 weeks, and you're collecting premiums halfway through. Like I don't know, man. There's these like stock purists who are like, no, you should hold this forever. But at the same time, there is such a thing as like all your investment performances are tied to the time in which you earn that money, right? So it does matter. And if I don't get hit, then I'll just continue writing covered calls on them for other prices.
Yeah, no, and I've not taken any gains on any leaps for SoFi yet, but yeah, I might do like, I don't know, no more than 1,000 shares, I don't think, but at that price level, I wouldn't mind taking some. Actually, probably do poor man's covered calls, although there's more risk on that. So if you guys have never heard of that, don't trade them. They are a little bit more risky than covered calls, but yeah, I'll have to take a look at that. Thanks, Tevis.
You're welcome. And with that, we are going to sign off for the day. An hour and 20 minutes. The second bootleg in a single week. We're making up for lost time over the holidays. Thank you. Yeah. Oh my God. How terrible would it be if you were forced to take a profit? Exactly. Perfect note to sign off. Thanks so much, everybody, for being here and watching and following along. And remember, we have SoFi Weekly coming up on Friday. And then on Monday morning, bright and early, I want you with your coffee ready because we have the SoFi earnings call that we're going to be watching and listening to together. We're also going to have special guests on there, some new special guests that haven't joined us in the past for the SoFi Weekly. So it's going to be a really fun stream. We're probably going to put up the stream in the next couple of days. Thanks so much, everybody, for being here. And of course, we will see you on the Bootleg Weekly next week. Yeah, that's it. Okay, bye.